Hello, very good morning to all, and welcome to a brand new week ahead. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. I hope that you all have a great, restful weekend, and very good morning. Today will be Monday, the 8th of July, 2024. So before we jump straight into our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, and as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into today's short-term intraday technical outlook on the major cross assets, let's have a recap of what has taken shape on Friday, over the weekend, and as well as today's Asia early morning session in terms of news release, economic data, and how their impact towards the major cross asset classes. Okay, so let's start with the economic data released on last Friday first. So on last Friday, we do have one key economic data release, especially that is primarily focusing on the US economy, none other than the all-important non-farm payroll data. Why? Because this data is one of the key metrics that the US Federal Reserve were to decide whether to cut interest rate in terms of the magnitude of the cut and as well as the timing of the cut. So the non-farm payroll data, what we could see over here on my screen, okay, let me expand my screen so that you guys could see much clearer. Okay, great. So non-farm payroll data, it actually came in slightly above expectation. Market's expecting 190K jobs added. It came in at 206K job added. But what's surprised the market over here is that the previous 2 months of data release was downwards revised, because in terms of US data release, especially on the non-farm payroll data, it tends to be, we call it the agency that compile the data will fine-tune the collection data set, and if there's any new changes or I would say that filtering process that they require to actually revise upwards the prior month data, they will actually do so. And it actually happened, take shape on last Friday, where previous month data, you could see my screen over here, was revised downwards significantly. So previously last month, it was reported for the month of May, added jobs was 272K. But after a new data flow came into this collection data set as being compiled by the US agency, it actually revised downwards to 218K. So that number of downward revision is pretty significant on the downside. So if you look at the trend of the US non-farm payroll data, as you could see on my screen over here, all right, and the April one was also revised downwards as well by 57K to 108K. All right, over here for the month of April. So what we could see over here is that the previous 2 months of downside revision on their prior data releases, indicating to us that there's some signs of sluggishness in the US job market. Okay, that's one thing. And another thing, aspect of the non-farm payroll data, they also released the unemployment rate. So the unemployment rate actually ticked higher from 4%, that was market is expecting as well, to 4.1%. So if you look at the trend of the unemployment rate over here, okay, we see it ticking up significantly, and this is the highest level of unemployment rate close to a year. So you look at the 5-year trend, 4.1. So in fact, this is the highest increase since October 2021 in terms of the level. So what it means over here is that an uptick in unemployment rate, downward revision in the prior 2 months of May and April for the absolute non-farm payroll number of jobs added per month basis, indicate to us that the US labor market has started to face a very clear slack. All right, that means softness in the US job market. So that actually prompted or increased the odds of a imminent up and coming US Federal Reserve interest rate cut in the month of September. So what we could see over here based on the Fed funds rate, okay, let me show you the Fed funds rate expectation as compiled by the CME Fed Watch tool using the Fed funds futures interest rate market. Okay, to let it load for a while. Okay, let's look at the combined probability. Okay, so the combined probability over here, okay, it starts to show a very high, another 10% increase combined, we call it combined or aggregated meeting probability. So for the month of July, this end of July, market is still expecting the Fed will not do a cut first. So almost certain that based on the current CME Fed Watch 2 calculation based on the pricing of the Fed funds interest rate futures market, the current Fed fund rate is at 5.25% and 5.5%. Market is actually expecting almost no change on July because there's a high odds that remains the same at 93%. Only a small chance of 7% that they potentially could cut by 25 basis points to bring it down to 5.5% to 5.25%. So this is the Fed funds rate going forward. So this is the current Fed funds rates right now, and the first cut is expected at 80%. So prior to the non-farm payroll data release, it was around 70%. So there's a 10% incremental increase. So now markets now has pinned up high hopes that the Fed will start to move the needle by expecting a high probability chance of 81% of a 25 basis point cut to come in the September meeting. Okay, so mind you, this is a US formatted date. That means the first digit that you see over here on your left side is month, date, year. Okay, so this is pretty much clear. Then on November, same thing, they will pause, no change over here, keeping it at the odds of 75% after the first cut to come in September. Then we do have another cut after the US presidential election in the 18th of December FOMC meeting. So market is expecting a high chance of an aggregate probability of 96% of another 25 basis point cut to bring it down to 4.75% slash 5%. So what we could see over here previously, before the non-farm payroll data, I do highlight this this particular probability on this website as well. Previously, it was showing at around 80%. So these 2 months over here has a bump up of additional 10% incremental in terms of the chances of odds over here. So what we could see over here is that the US expectation or the market expectation has started to increase of at least 2 interest rate cut before 2024 ends, and the probability of it increase has started to be incremental on upside, increasing so of about respectively of a 10 basis point each. All right, so that's for the data releases, and it impacts on the Fed funds pricing. So overall, for sure, we start to see number one, dollar weakness starts to creep back into the market. And what we could see over here is that good news is not bad news, is good news for the risk on behavior. Why? Because of additional liquidity that is being fed into the market. So right now, despite the fact that yes, there could be a risk that the US may slip into a recession, but on a very short-term basis, once market starts to have a reaction in terms of much more liquidity is being added to the market, in the short-term basis, the risk on behavior will start to surface first, until when we start to see earnings downside revision significantly due to the risk of earnings margin being compressed due to a slowdown economy. Then from there, we could start to see a much more corrective pullback in the stock market. So in the the short-term basis, once this additional expectation of an immediate Fed funds interest rate starts to tick off higher on the upside in terms of a probability increase, we start to see a very strong reaction in the stock market. So across the board, the S&P 500 and the Dow Jones Industrial Average, the S&P 500 and the Nasdaq 100, all make fresh new all-time high on Friday. So what we could see over here is that the top performer again is centered around the mega cap stocks. That means primarily driven by the technology mega cap stocks, the likes of Apple, Amazon, Meta, whatsoever. The Nasdaq 100 is up close to 1% on Friday, followed by the S&P 0.55%. So all of them actually rallied very sharply upon the release of the non-farm payroll data right ahead of the US session open on last Friday. A very strong rally, similar by the this is the Nasdaq 100. The Dow Jones Industrial Average, not so much, but still managed to close at a positive level with a slight gain of 0.2%. So why the reason why the Dow Jones actually underperformed? Because the Dow Jones component stocks, yes, they do have three mega cap stocks inside, mega cap technology stocks, Apple, Microsoft, and Amazon, but their weightage is not as huge as compared to the financials, the healthcare, and the industrial stocks combined in the Dow Jones Industrial Average. Because the Dow Jones Industrial Average, yes, I repeat again, they do have three technology mega cap stocks within their 30 component stock, but their combined weights attached together, that means Apple, Microsoft, and Amazon, is very little compared to the weightage of other financial stocks inside the Dow Jones Industrial Average, and as well as some healthcare stocks and cyclical stocks that make up a bigger component. So if you look at the S&P 500 heat map over here, okay, so what we could see very clearly, like I explained earlier, the market on Friday in the US stock market is being led by the mega cap stocks over here. Microsoft 1.47%, Apple 2%. All these are fresh all-time high for Microsoft, Apple. Google 2.44%, Meta 5.87%, and Amazon 1.22%. And even the laggard since the start of this year is catching up as well. Tesla is up 2% right now. So if you look at the year-to-date performance, all right, oops, yeah, yeah, give me a minute. Year-to-date performance. Okay, so year-to-date performance, Tesla managed to actually inch out a slight gain after a very strong, stellar performance or magnificent performance since last week. So previously, Tesla was the weakest among, in fact, it's still the weakest among the 7 mega cap stocks because due to its rather adverse individual firm-specific impact of the EV price war or whatsoever against other Chinese EVs. But nevertheless, based on the last week's stellar performance, it managed to actually now slip back into positive territory, a slight gain of 1.22% year to date. All right, so now back to the impact on the one-day performance. Yes, we know that NVIDIA is the sole one that is underperforming. So will it be much of a concern to us, given the fact that those who followed my daily dose on a frequent basis, I do emphasize that NVIDIA is a very important play. Why? Because it's the leader of this AI-induced optimism team play that is leading the fort since this year and as well as 2 years ago. Okay, well, the NVIDIA underperformance on last Friday potentially lead to a collapse on the short-term basis for the US major stock indices, especially on the S&P and the Nasdaq 100, given the fact that they are heavily skewed towards these mega cap technology stocks, with NVIDIA being the leader. This I will reveal afterwards when I cover the intermarket analysis. All right, we'll take things one step at a time. Okay, another news flow I want to highlight to you all over here is the results of this French election, which is rather shocking. So this is the second round, which was more or less has been concluded because the polling was done yesterday. So what we could see over here is, let me expand my screen. Okay, so we know that last week there is a couple of horse trading going on between the Macron centralized party and the left wing, the socialists, to actually tell the right wing, which is Le Pen's National Rally Party, of preventing her party to get a majority in the France Parliament. Okay, which they managed to succeed. And what's interesting over here is that the Left Alliance is right now is a surprise victor, winning the most seats. And right now, President Macron's group, which is the more commercial, we call it a commerce-driven party, comes in second, and Le Pen's far right now drops to a third place. But if you look at the number of votes over here in terms of the percentage change, okay, over here, I think Okay, I think they will have, yes, this is the one from the data. So this new popular front, okay, managed to win 178 seats, which is the leftist, the socialist. Macron came in second now, 156, and Le Pen dropped to third place, 143. So if you look at the composite of seats, right, none of them managed to get a majority because the majority is 289. All right, 289 over here. So previously in the first round, Le Pen's just only left about 10 or 15 seats before hitting a majority of 289. So that was concluded 2 weeks ago. So that's why they have a face-off round yesterday. So after this face-off second round yesterday, this conclusion over here indicate to us that the France parliament now is something like a hung parliament. Yes, the euro dollar actually gapped down this morning because of the fear. Then after that, once the number of seats being tallied, okay, because why fear? Because the leftist party or the socialist far right party, the New Popular Front, is very advocating a very kind of highly aggressive physical spending policy, much more than the far right. So given the fact that if this New Popular Front managed to hit a majority, but which they didn't manage to hit, thankfully, they are also very unlikely to push their aggressive physical spending policy that could actually lead to a much more undesirable budget deficit in the French economy, because the French economy budget deficit, the budget deficit in France right now is already 5.5% last year, breaching EU limit of 3%. So that being said, that actually causes the euro to actually recover thereafter. So later I'll share with you the intraday technical chart of the euro dollar. All right, so it's more like a hung parliament right now. So given the fact that neither party managed to gain a majority, so despite the fact that that means there could be much more, I would say that debate going forward in terms of which party who wants to actually push ahead with their policy going forward. Okay, so in the short term, what we could see over here is that there's some uncertainty, but at least we know that the far right, even though they are favoring a very kind of a strong fiscal spending policy that could drag down the euro dollar, which in turns could lead to a risk-off effect in the eurozone, that likelihood seems to be very minimum right now, at least in the short term perspective. All right, so right now let us now jump straight to the fundamentals as well as the intermarket dynamics. Okay, so let us start with the US Treasury yield first. So we know right now, with the election out of the way, that means two key election out of the way, that means the the UK election as well as the French second round election. Now market right now will be pretty much focusing on the US yield, and their impact could be not much more now directly related to the FX market and as well as the stock market. Okay, so we know that the 10-year US Treasury yield over here is taking as an indication of the longer term cost of funding, okay, as a proxy, right? Because this is the most risk-free rate, okay, that was given the fact that the US Treasury yield is being used 10-year yield as a benchmark to price long-term corporate loans as well as potentially housing loans globally. So what we could see over here is that since last week, it failed to break above since end of June or early July, if 1st of July, it fails to break above the 4.5% key medium-term resistance level, and it's been trading downwards. All right, and on last Friday, it formed a black Marubozu bearish candlestick, reacting off the 20-day moving average, and very clearly closing below the 200-day and the moving average as well. So net overall is indicating to us further potential softness ahead for the US 10-year Treasury yield to at least test the next medium-term support at 4.05%. So given this downward trajectory of this 10-year US Treasury yield, it implies that the US 10-year Treasury yield premium against the rest of the world could potentially shrink, which could also lead to further weakness in the US dollar. So you look at the dollar index very clearly on last Friday, it broke down below this short-term range that we are highlighting at 106.37 and 105.24. So on last Friday, it clearly break down below this level over here. Okay, so now this is a red line. Okay, so the next support level to watch out for will be at 104 figure level. Okay, 104 figure level. So potentially in short term, we may start to see further dollar weakness coming into play as well. And with the slowdown in the US 10-year Treasury yield, that means i.e. it tells us that the longer term cost of funding in the US has started to be more on the soft side, start to reduce. So at least from a short to medium term perspective, that also supports the US stock market. So what we could see over here is that we see a very strong performance for now on the S&P 500 and the Nasdaq 100 being driven by the mega cap stocks. So later I'll show you the chart. Can the Dow Jones Industrial Average outperform going forward, or at least do a catch up? Okay, bearing in mind possible. Later I'll flash you another intermarket dynamics on the US stock market. So before that, let's take a look at this is the 10-year, right? So let's very quickly go to the 2-year as well. So the 2-year, so what you see over here is that the 10-year actually dropped by 6 basis point on last Friday. Yeah, 6 basis point. So if you look at the 2-year, the fall of the 2-year, it actually dropped much more by 8 basis point. And do not forget, if you look at the breakdown, it actually broke below the 14th of June swing low. Over here, 14th of June, okay, the 12th of June swing low. Let's go back to the 10-year again. Okay, the 10-year again, over here, it hasn't broke below the last lower low. Okay, the last lower low over here, it didn't break below the last lower low, still holding above it. But for the 2-year, it really broken below the last lower low. Okay, very clear. And the percentage of drop on last Friday is much more than the 10-year, because the 10-year dropped by 6 basis point. The 2-year dropped by 8 basis points. So this actually comes into a very related move of a much more aggressive Fed funds futures pricing, a dovish one, that increase the odds of the 2 interest rate cut potentially in September as well as in December this year, which I showed you earlier on the CME Fed Watch 2. So what it means over here is that market is now looking up for the 2-year Treasury yield to fall at a faster pace compared to the 10-year Treasury yield. Why? Because they are actually pricing in right now a much more potential dovish US Federal Reserve monetary policy, because the 2-year has a higher proxy to monetary policy. Okay, so that being said, that how does it react to the stock market? All right, so now stock market, before that, let us look at the stock market performance first, year to date. So as you could see, I explained earlier, this is on last Friday. So this is the K-shaped performance. We know that NVIDIA is the market leader, 171.27%, leading 100, more than 80%, more than 20%, triple digit gain year to date. Okay, this year to date. And this one is the mega cap 7 stocks plus Netflix. That means together with Tesla, mega cap inside as Tesla. So I would say that it's still mega cap 7. That means initially, if you want to minus off the other two, Netflix and Tesla, some of them will do so. Why? Because Tesla and Netflix is not considered as a tech mega cap. All right, but if you put them two together, which I will still will do to make it much more in line, they are up 35%. All right, year to date, or 36%, leading the Nasdaq 100. All right, so what you could see over here in the major benchmark indices over here is that this is the Dow Jones Industrial Average. So the Dow Jones Industrial Average is the one that is lagging behind at 4.4%. Okay, way below the S&P and the Nasdaq 100, which is both up by 23% and 70% respectively. So now the key thing over here, with this gap right over here, there's a significant gap between the Dow Jones the Nasdaq and the S&P. Can this gap be covered going forward? Well, to me, yes, there's a possibility. Why? This is why I want to show you the possibility over here. Okay, this chart over here tells us what's driving the US market performance right now. The top chart is the S&P 500. Over here is the relative strength chart between momentum and the S&P 500. So this momentum, for those who actually followed my daily dose of market insights, telling us that what the ETF does over here, the SPMO ETF, no change in the S&P 500 component stocks. They are still the same, except that they are being re-ranked according to the momentum factor. That means S&P 500 component stocks that has a higher momentum factor ranking will be ranked at the top with the likes of Nvidia, Microsoft, Apple, so ever. And those who have a lower momentum factor will be ranked lower. So they kind of re-rank the S&P 500 stock according to the momentum factor. So I could see this momentum factor has been doing all-time high since 20th February this year. And on last Friday, they continue to push towards all-time high, very much in line with the outperformance of the mega cap technology stocks. All right, so what you could see over here is that the momentum factor is the one that is driving the current leadership in the US stock market. However, the enhanced value ETF is actually lagging behind because they are not making new higher high, and in fact, they're making new lower low in terms of the relative or the ratio chart where I plotted the S&P 500 enhanced value ETF, they call it SPVU, divided by the S&P 500 ETF, the SPY, is actually making lower low. So what I could see over here is that value factor in the US is actually underperforming right now. That means, like I say, this is the S&P 500 enhanced value ETF. No changes to the component stocks of the S&P 500, except that this ETF, they re-rank the stock according to the value factor. That means S&P 500 stock that has a higher value will be ranked at the top. Okay, this is what it means. All right, so we know that at the point, so they could actually break down according to, they call it smart beta ETF according to the various factor. Okay, so the value factor has been underperforming the S&P 500. That means they are not the market leader right now, they are the market laggard. And value, the value stocks, a lot of them are banks, financials, energy, and healthcare, which forms a significant component inside the Dow Jones Industrial Average. So that actually explained to us the Dow Jones underperformance year to date, which I flashed to you this particular chart earlier on. Okay, the Dow Jones year to date. Okay, now how does this potential enhanced value could see a chance of an outperformance again, somewhere very similar to November 2020 to June 2021, around 1.5 or 2 years ago. Okay, previously, you know, this upward sloping line here from November 2020 to June 2021, where the value factor actually outperformed the S&P 500. So what causes it to outperform? Intermarket dynamics is due to a steepening of the US Treasury yield curve over here. So what I did over here, this purple line, I plotted the difference between the US 2-year yield minus of the US Treasury 2-year yield. Okay, so it's basically the 10-year minus 2-year is a yield spread. All right. So notice that over here, there's a steepening of the yield curve. Okay, that lead to the outperformance of the value factor. And right now, there is another chance of this potential bull steepening taking shape as well. So what is bull steepening? Okay, bull steepening is where the lower end, the 2-year actually went down at a much more higher magnitude compared to the 10-year, which I flashed you all earlier. See, on last Friday, the 2-year starts to drop by 8 basis points, whereas the 10-year only dropped by 6 basis points. Okay, so this actually explains a potential bull steepening. All right, so initially the yield curve, we call it inverted, right? We have an inverted yield curve over here where the 2-year minus the 10-year minus the 2-year treasury spread is in negative territory. All right, so but this negative territory has slowly starts to uninvert, and right now is showing a potential bull steepening, and a breakout above this key resistance, key medium-term resistance at negative 0.8% on this yield spread could further increase the likelihood of this bull steepening on the 2-year minus 10-year yield spread. And once this breakout of this negative 0.8% happen, it could lead to something very similar to this similar steepening that has taken shape in November 2022 to July 2021. And that when that happened, that saw the value factor outperform the S&P 500. Okay, the value factor within the S&P 500 outperform the S&P 500 index by this ratio chart. So if this yield curve continues to push up and create that potential bull steepening on the break of that negative 0.08%, that could see this line here moving up as well going forward. Okay, very similar to what we did over here on November 2022 to July 2021. June 2021. So once that's happened, the value factor will outperform, and that where we start to see potentially the Dow Jones Industrial Average could starts to cover its underperformance gap so far. And if you observe the individual technical chart on the S&P, on the Dow Jones Industrial Average using the CFD, which is our US Wall Street 30, this is the daily chart. In fact, since its all-time high in March this year, it's been evolving within a bullish ascending channel as well. That means it's consolidating, but it's not consolidating in a topish configuration. In fact, it's consolidating within a bullish continuation chart pattern, which is called a ascending triangle. So we are still also looking for that break of that 40,030 level. So put in parallel, the 40,030 level on the Dow Jones Industrial Average, or i.e. the US Wall Street 30, is very equivalent to that potential breakout level of that negative 0.08% on the 2-year, 10-year minus 2-year US Treasury yield spread to kickstart that potential bull steepening on that US Treasury yield curve. Right. So net overall, what I could see over here is that going forward from the medium-term perspective, the value factor may do at least a medium-term outperformance, like what it did previously from the November 2022 period and the 17th of May 2021 period, due to a much more aggressive pricing of a much more US Federal Reserve monetary policy, more on the dovish side. And with that happen, that could start to see the Dow Jones Industrial Average or the US Wall Street 30 to cover its underperformance gap that we see so far at the start of this year. So that's from a medium-term intermarket dynamics perspective. All right. So with that, now let us now jump straight into the short-term intraday technical outlook on the various major cross-asset classes, starting from the FX pair. So before that, let me expand my screen so that you guys could see much clearer. Okay, so before we jump into the FX pair, let us look at the 5-day rolling performance of the dollar versus the other major currency of 8th of July. Okay, so what you could see over here is that after the release of the non-farm payroll data, and we know that with the election out of the way, UK as well as the French second round election, right now the FX dynamics is now more correlated with the movement of the US Treasury yield. Okay, we has been softening on Friday. So what we could see across the board, we start to see the dollar weakness coming back into the picture, where the weakest so far is being the Aussie dollar. The dollar is the weakest against the Aussie, the sterling, the Kiwi. All right, you can see over here. Okay, so dollar weakness, at least in the shorter term perspective. And even the strongest previously, the yen also starts to weaken as well, with the breakdown of that 161.10 pivotal support that we highlight on Thursday before I went on the leave on Friday. Now, with that, let us now look at the intraday technical outlook on the euro dollar. So euro dollar very clearly before on Thursday we were neutral between this 107.90 and the 107.10 level, broke above the neutrality limit over here. This morning it gapped down, it managed to recover and cover the gap over here, so indicating to us bullish momentum. And what we could see over here is that even the hourly RSI has starts to bounce off from the 50 level mark as well, okay, over here. So indicating to us short-term momentum seems to be intact for the euro dollar. So with that over here, what I could do over here is that I will actually use this this level here, this former minor swing high area on 1st of July, 1.0770 as my short-term pivotal support level. The first support level to watch still at 1.079 level, very close to the intraday low on last Friday. I don't put it so tight. Okay, I put it 1.0770. So as long as 1.0770 short-term pivotal support holds, we will flip to a bullish bias on the euro dollar. Next near-term resistance to watch will be at 1.0850/1.0860. Above this level, potentially sees 1.09, 1.0925, which is the swing high area of 4th of June. Only an hourly close below 1.0770 will invalidate today's intraday bullish bias to see a choppy pullback corrective pullback move to expose the 20-day moving average, acting as a near-term support at 1.0750. A breakdown below it, revisit the 2nd of June minor swing low at 1.0710 area. Okay, so if you were to do that Fibo retracement of this current recovery, okay, is at the gold 50%, and as well as the 76.4% for the 71.0710 level support level next, if the 1.77 short-term pivotal support breaks down for today. Now the sterling dollar, so the sterling dollar last Thursday we were also neutral, okay, broke above the neutrality limit over here. So what we could see over here is that on the daily time frame, it actually broke above this symmetrical triangle range configuration that is in place previously in July 2023. All right, a breakout from this symmetrical triangle range configuration, indicating to us going forward, we could start to see further potential upside towards 1.2965, then thereafter a retest at the 1.3140 level. So that more from a medium term perspective, I would say. So on the shorter term perspective, the market still remains in a bullish dynamic over here. So what we could see is that the hourly RSI continue to shape a higher low. All right, no clear signs of a bearish divergence at this juncture. So what we could see at this point in time, the first support level to watch is the pullback of this symmetrical triangle range resistance. Now turns to a pullback support at 1.2770. So this was first support. The second support will be on last week low at 1.2730 level. All right, so I will use this 1.2730 level as my short-term pivotal support for today to flip to a short-term bullish bias on the sterling dollar. Over here, next resistance to watch out for, since it's already broken, now test breaking above the 128 figure level. Okay, will be at 1.2860 level. Okay, 1.2860 level. So above 1.2860 level, which is the swing high area of this 12th of June, potentially takes us up higher towards the 12930, 12940 level. Okay, so what is 12940? If we go to the daily time frame, okay, is this swing high area of 26th of July last year. Okay, and as well as a Fibo extension level, taking into consideration of this level here, 0.764. Okay, now going forward, let me go to the 1 hour chart again. Okay, only a breakdown below the 1.2730 level will invalidate today's bullish bias, pardon me, will invalidate today's bullish bias. Okay, and this will lead to a more or less a failure bullish breakout on last Friday and kickstart another round of choppy corrective decline back towards this range support area over here. First support level to see 127 figure level, followed by 12650 level, okay, on the sterling dollar. Now with that, dollar major against the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar also starts to shape this bullish breakout above this 160.30, 160, 1610 level over here. Okay, so 1610 level. So this level here will be like a pullback support, or 16690, yeah, 16690 thereabout. Okay, so this level here has been clearly broken out on the upside on last Friday. So this is a very clear bullish breakout of a medium-term symmetrical triangle range configuration. Okay, that has kept previous upside since late December last year. So with this bullish breakout taking shape over here, right now, the next resistance to see will be this long-term secular descending trend line that is in place since 25th of February 2021 high. Okay, so that will be the next resistance zones to watch out for, will be at the 69 figure slash 07010 level. Okay, so that will be more on the medium term basis on the Aussie dollar upside potential resistance zone to watch out for. So on the shorter term basis, if you look at the hourly time frame right now, it's actually bullish over here. So what I could do over here is that this will be the first support level to watch at 67.20, just in case of any potential pullback, given the fact that the RSI now is inching upwards. Haven't hit the overbought level yet, but it could hit it pretty soon during the European session or the US session. But with that, that could be the first pullback at 67.20, using 67 figure level as my maximum pullback level, which is potential maximum pullback level, which is my short-term pivotal support that I have for today. So 67 level also will be the pullback of that former symmetrical triangle range resistance. Bullish breakout now turns into a pullback support level, and as well as the former minus swing high of 4th of June and 12th of June also confluencing at the 67 figure level as a pullback support. So 67 figure level, as long as the potential minor pullback didn't surpass below 67 figure level short-term pivotal support I have for today, still maintain flip to a short-term bullish bias on the Aussie dollar. Next near-term resistance to watch 67.80, followed by 68.25, 68.40 next. Okay, so 68.25, 68.40. If you go to back over here, is the congestion area of 2nd of June and 29th of December. Okay, now with that, if we start to see a breakdown below 67 figure level, then what we could say that last Friday bullish breakout is a failure, and where the Aussie dollar will start to transverse down towards the downside again, back towards the lower limit of the symmetrical triangle range configuration. Given that it reintegrate below 67 level is a failure bullish breakout, implying so the next near-term support level to watch in first step will be 66.70, which is the confluence with the rising 20-day moving average. Below it, see 66.40, which is the minor swing low of 2nd of June, also confluencing with the upward sloping 50-day moving average as well. Now, dollar yen. So dollar yen, like I said, it broke below 161.10 level, which is bearish. And if you look at the weekly chart that was concluded last week, over here, the weekly candle also formed a bearish hanging man. Okay, a bearish we call it a bearish shooting star like pattern, all right, over here, or we call it a bearish dragonfly gravestone doji, all right, a bearish gravestone doji. So on Friday it formed this weekly bearish reversal candlestick right exactly at the upper limit, because there was a no clear breakout on the upper limit of this major ascending channel that I drew from the low of 16th of January 2023 low. Okay, so close to about 1.5 year channel. So bearish reversal weekly candlestick hitting the upper limit of this channel after a test of it during the intra-week period of last week, failure to close above. So this indication that there is signs of a mean reversion, at least back down towards the 15650 medium term pivotal support level, 15650. All right, so from a multi-day perspective, there could be this corrective pullback right towards this 15650 level. All right, so now from a intraday perspective, we will take things one step at a time first. All right, so from an intraday perspective, after the break of that 16110, the first support level has really been met at 16030 over here. So what we could see over here is that price action continues to do lower over here, move out lower with the hit of this 16030 level. Right now there could be a potential pullback taking place. All right, so pullback level to watch out for will be at this 16140 level. So very clearly 16140 will be this close to this level here. 16140 will be the potential magnetic force for this minor pullback. And do not forget over here is that we also start to see this bullish divergence, okay, on the hourly RSI, indicating a higher chance of a steeper minor pullback. So this 16140 over here, if you do the Fibo retracement of this current ongoing slide all the way down to today's Asia session low, is also converging with the 61.8 golden ratio as well. All right, very closely. So what I do over here is that I will actually wait for the price action to come close to this pullback level, given that majority of the FX pair are still favoring dollar weakness instead of dollar strength. So over here, as it will come very close to the 16140 short-term pivotal resistance. So i.e. that means as long as this potential bounce or mean reversion, we call it a snapback rally, minor one, didn't surpass 16140 short-term pivotal resistance that we have for today on the dollar yen, that means somewhere around hit this level, I will flip to a bearish bias, okay, potentially for the dollar yen to continue this near-term weakness, break down 160.30, exposes the next supports level on the intraday basis, 159.10, followed by 159.90 first, then thereafter followed by 159.10, which confluence with the rising 20-day moving average as well. However, if we start to see a breakup above 16140, that means we have an hourly close above 16140, then this short-term bearish bias will be invalidated on the dollar yen. Will potentially see a further recovery on the dollar yen to retest this 38-year high at 61.95 and even start to seek a higher high at the next resistance at 16240 next. All right, so that's pretty much sum up for the intraday technical outlook on the dollar major pair, which indicate to us there is still some form of short-term dollar weakness going forward. Now, moving on very quickly will be the major stock indices, starting from the Asia Pacific pair first. All right, so now let us start with the Japan 225. So the Japan 225 over here, okay, what we could see over here is that the price action is going to go sideways within this short-term pivotal resistance zone that we highlighted on last Friday, 151025, 51175. So it hasn't break above 5175 yet so far. What we could see over here on the hourly RSI, it continues to flash out that bearish divergence. Okay, at this point in time, didn't break above this resistance line yet. So with that, we will still maintain that short-term bearish bias on the Japan 225 for at least a minor mean reversion decline scenario to take shape within its still ongoing short-term uptrend, because the price action is still trading above the 20-day moving average. Okay, first support level to watch will be at 40,506 level, which is the minor swing low of last Wednesday. A break below it potentially exposes this minor congestion area of 2nd of July and 8th of July, which is the 40,230 level. And if you do the Fibo retracement, okay, from the low of 27th of June, that also corresponds with the 50% Fibo retracement. Only an hourly close above 41,175 short-term pivotal resistance. We will invalidate this minor corrective pullback scenario on an intraday basis to resume its impulsive upmove sequence within its short-term uptrend. Next resistance level to watch on an intraday basis will be at 41,460/500, followed by 41,770, which confluence with this Fibo extension over here, the 1.236 and 1.386, taken from the low of 17th of June. All right, that's for the Japan 225. Okay, the Hong Kong 33 or the Hang Seng Index continue to remains weak over here. breaking below our 17,000 so-called 700 short-term pivotal support that we have on Thursday, could to inch lower and print a lower low, and now breaking below the 28th of June swing low of 17,600. So what I could see over here is that this Hong Kong 33 or Hang Seng Index continue to trade within a short-term persistency weakness, and very clearly there's a minor downtrend channel taking from the high of 5th of June. So there's this descending channel that is in place since close to about 2 months over here. So with that, with the break of below this 17,600 level, potentially we could see lower lows taking into shape on the Hong Kong 33. Okay, so with that over here, the first resistance to watch for today, okay, will be this breakdown level. Oops, sorry. Okay, at 17,585, but as long as this level didn't surpass above this level here, let's put it a bit tighter. Okay, this breakdown here, 17,760, because there was a bearish reaction intraday on Friday. Okay, there's a market hitting this 17,600 before shaping that's gap down in today's Asia session. All right, so as long as any potential bounce or snapback bounce didn't surpass 17,760 short-term pivotal resistance that we have for today on the Hang Seng Index of the Hong Kong 33, potentially there could be further weakness coming into play. Next near-term support level to watch will be at the 17,460, followed by the all-important 200-day moving average that is acting as a support as well at 17,170. Also the lower limit of this minor descending channel that I drew from the high of 5th of June, and this 17,170, pardon me, 17,170, also confluence with the former minor swing high of 13th of March and 10th of April. Okay, only hourly close above 17,770 will negate today's bearish intraday bias to see a further squeeze up towards the 20-day moving average that is acting as a resistance, 17,970, followed by 18,125, which is close to the upper limit or the minor descending channel resistance that is also confluencing with the minor swing high of last Friday. Okay, so that's for the Hong Kong 33, the Hang Seng Index. Moving on will be the German 30 over here. So for the German 30 or the German DAX, last Friday it managed to stage that squeeze up above our neutrality zone, but hit a short-term resistance before reintegrating back down. There's a sell-off, and it reintegrate back below the descending trend line that I drew from the all-time high of 16th of May. Okay, so it seems to us that it's still a very choppy movement on the German DAX or the German 30, given last Friday failure bullish breakout over here above this former descending trend line from the all-time high of 16th of May, reintegrate back below it, and on last Friday it closed below this descending trend line, so indicating some form of hesitation by the bulls to push it higher. So what we could see over here is that we could see another round of very choppy downside movement within the range over here, where it start to see breaking down lower lows. Very hard to say right now because things are rather mixed and fluid given the outcome of the Hung French Parliament. So with that, potentially on the short term, we could still see it floating down to retest the 20-day moving average that is acting as a support level right now. So using the 18,640 as my short-term pivotal resistance for today, flip to a short-term bearish bias within a very rangy, choppy short-term range configuration that is inherent in the German 30 or the German DAX right now. First support level to watch 18,430, a breakdown below it sees a retest at 18,300, which is also confluencing with the 20-day moving average acting as a support. When an hourly close above 18,640, then we will start to revisit the potential bullish breakout scenario again to see a potential higher high level on the intraday basis to test the next near-term resistance at 18,750, followed by the minor swing high of 28th of May at 18,450, 18,450 slash 18,900. And if you do the Fibo extension over here, okay, that's also conversing with the 1.618 Fibo extension level as well. Okay, so that's for the German 30 index. Now moving on will be the Wall Street 30. So no change on the Wall Street 30. Are going to trade sideways below the first resistance that we highlighted last week at 39,600, but still holding above the 50-day and the 20-day moving average. So I think as a support zone at 39,090 slash 39,030. So we tidy up the pivotal support slightly higher. 39,090 slash 39,030 short-term pivotal support, still maintain the short-term intraday bullish bias on the US Wall Street 30, the Dow Jones Industrial Average. A breakout above the 39,600 level potentially sees the next near-term resistance coming in at 39,790, which is the congestion area of 21st of May and 22nd of May. Only an hourly close below the 39,090 slash 39,030 short-term pivotal support level exposes the next near-term support at 38,730, followed by 38,560 slash 38,420. Okay, now Nasdaq 100. So before that, let us look at NVIDIA, which has a high component weightage in the Nasdaq 100, being the second biggest weightage stocks. Make the second biggest market cap stock in the Nasdaq 100. Yeah, despite NVIDIA yesterday, it underperformed on last Friday. The technical chart of NVIDIA is still showing no signs of a big bearish reversal, still holding above the key short-term support zone at 11832 slash 10988 over here. And yesterday price action, last Friday price action also managed to hold above the hold right at the 20-day moving average. And despite last Friday's sell-off, the sell-off came with a very low volume, all right, rather than the high volume. Okay, so indicating to us that the short-term uptrend still remains intact for NVIDIA, and it continues to try to actually bounce above this rising 20-day moving average. So net overall, it could still be rather positive on the price action for the Nasdaq 100. So now with that, let us take a look at the Nasdaq 100 technical analysis perspective on our chart. So no change, the Nasdaq 100 going to inch higher. No signs of a bullish exhaustion. Why? Because the RSI continues to shape a higher high in line with the raw price action of the Nasdaq 100 on our chart. So with that, we do have a tightened key short-term pivotal support for today using the former minor swing high of 20th of June at 2090 level. So as long as any potential pullback managed to still hold above 20,090, so potentially we could see a minor pullback because it's at the overbought level already. There could be a minor pullback coming into play. The first support level to watch will be this level here at 20,250 level. All right. As long as the pullback didn't surpass below 20,090, still maintain that short-term bullish bias on the Nasdaq 100. Next resistance level to watch, 28,490, followed by 20,620, 20,710, which is confluence with the Fibo extension cluster level. Only an hourly close below 20,090 will negate today's intraday bullish bias to kickstart a much more deeper minor corrective pullback to test the next near-term support at 19,850, which confluencing with the rising 20-day moving average, and as well as this minor ascending channel lower limit or the support that I drew from the low of 31st of May. Okay, so that's for the intraday technical outlook on the Nasdaq 100, and we sum up for the intraday outlook for the major stock indices as well. So with that, let us go to the commodities market, starting with spot gold. So spot gold continues to be bullish. What we'll see over here. So what I could do over here is that price action really hit the first resistance at 2,386, and right now potentially is already exit from the overbought level, and we could start to see a impending minor pullback. All right, so as long as this minor pullback managed to hold above this tightened short-term pivotal support level or zone that I have for today, 2,362 slash 2,350, which is last Friday intraday low, the price action on gold XAU slash USD still remains in a bullish dynamic on an intraday basis. So the next support level, no, the next resistance level to watch will be at 2,410. All right, on the intraday basis. Above 2,410 sees 2,435 next, which is the minor swing high of 21st of May. only an hourly close below 2,350 over here will negate this bullish tone to see a deeper pullback towards the 50-day and the 20-day moving average that is acting as a support area as well at 2,335. All right, below 2,335, then that bullish breakout scenario last week will be in jeopardy because price action integrate further, and in the near term it will expose the next near term support first step at 2,318. Okay, so that's for gold, XAU/USD. Lastly will be the West Texas crude oil. So West Texas crude oil on last Friday, it hit the first resistance that we highlighted very closely at 85.05 level. All right, almost hit it because it printed a high of 84.74 before breaking down, and right now it really broke down below this minor ascending channels support that I drew from the low of 4th of June. So given the bearish breakdown over here of this minor ascending channel, and with the bearish reversal candlestick that was seen on last Friday, the shooting star right exactly below the first resistance of 85.05, that could potentially kickstart a minor corrective pullback on West Texas oil on an intraday basis. So with that, we will flip to a bearish bias on an intraday basis. 85.05 key pivotal resistance. Next support level to watch for it to shape that minor corrective pullback. 81.90, a break below it sees 81.30, which also conferencing with the rising 20-day moving average. Only an hourly close back above 85.05 will resume its minor impulsive up move sequence to test the next near-term resistance at 86.20 and even 87.85 next. All right, so that sum up for the intraday daily outlook on the major cross asset classes. So before we go, let's have a quick look at today's calendar. What are the key economic data to look out for? So today's calendar will be rather quiet. I would say not much key data to look out for, with the fact that only we do have a Germany trade balance that is out at 2 p.m. Singapore time, then followed by this US consumer inflation expectation. That is, I believe this is compiled by one of the Federal Reserve Bank in US. I mean, one of the regional bank for June. That is will be out at 11 p.m. Singapore time, and we do have some Bank of England officials speaking, Benford speaking at 12:15 a.m. Singapore time later tomorrow morning. And before the start of our daily dose in early Asia session tomorrow, 8:30 a.m. we do have the release of Westpac Consumer Confidence Index or data for Australia. So with that, that sum up today's daily dose of market insights. It's a bit longer. Why? Because I need to share with you all a new upcoming intermarket dynamics that potentially could take shape from a medium-term perspective on the cross asset classes. So with that, I do wish you all a great day ahead, and we shall speak again tomorrow. This is Kelvin here, signing off. Thank you.